Hello, I'm Huntsley, and welcome to Livewire's Fund and Focus. Joining me is Jeremiah Lane, partner and portfolio manager for KKR's leveraged credit funds and portfolios based in San Francisco. Good to see you, Jeremiah. Thanks for joining us.
Thanks for having me.
Let's chat about the fund that you work on, and that's the KKR Global Credit Opportunities Fund. Tell us about the key features of that fund.
GCOF, as we call it, is a concentrated portfolio of our highest conviction ideas. We invest in loans, bonds, CLO tranches. We do it in a concentrated way. Typically, 10 individual credits will be about 30% of our portfolio. 20 individual credits will be 50% of our portfolio. We've run the strategy for 15 plus years with highly differentiated outcomes to our investors. And we really think that over that time, we've demonstrated that this strategy can be successful across economic environments, Fed policy environments, political environments. We've proven out.
All right, well, if the fund's been running for a long time, as you say there, since pretty much just after the GFC, really during the depths of the GFC, do the team have a Northstar for your investment process? You know, those non-negotiables that you've got to hit?
Yeah, our Northstar is traditional credit underwriting, durability of cash flow, downside protection. Nothing that we're doing in here is we're never trying to take a company through bankruptcy and own the equity on the back end. We're not trying to do any tricks.
Sure.
We're trying to get the company that we are investing in to pay us back par on the instrument that we invest in. We find these ideas from over 1,000 issuers that we have in our portfolio, and we distill it down to that concentrated group of names. Like I said, 10 names are 30% of the portfolio, 20 names are about 50% of the portfolio.
So as a global credit investor, what are the key differentiators for the fund?
Sure, I think that the fund has done a really good job specifically in lower rated debt. The fund really takes advantage of investor sensitivity to downgrades, investor sensitivity to changes at the rating agencies. And we see price discontinuities around downgrades. Just because a Moody's analyst said that it was one rating yesterday and it's a worse rating today, that can cause the price of a loan or a bond to trade down 5 points. We love that opportunity. We love the opportunity to dig in on a credit like that and say, today we can buy it 5 points cheaper. Nothing actually changed about the company. And if we can go back to our North Star, if we can validate durability of cash flow and downside protection on that company, and we can now buy it 5 points cheaper, we'd like to do that again and again and again.
So what market conditions does the fund aim to capitalize on?
I think that really, at this point, the fund has been running, through a huge range of market conditions. So I don't think that there is one type of market that we succeed in. We've had differentiated returns over a 15-year period. I think that if there is a moment where we have often had particularly kind of magical outcomes for our investors, it's been coming out of a moment of dislocation. Coming out of COVID, we had some incredible returns. Coming out of the 15-16 energy sell-off, we had some incredible returns. Coming out of the GFC, we had some really incredible returns. But I don't want that to take away from the fact that we've had really good returns in the quieter moments, the moments where the economy was just chugging along. Those have been moments of particularly high excess returns, but we've done really well in a huge range of market environments.
Okay, well, that's good to hear. So you talk about 20 names making up 50% of the portfolio. I guess give us an idea of the characteristics of the assets that are inside that portfolio.
Yeah, sure. I think that some of the, probably the number one theme that we like today is short duration. And these are names that mature in the next year or two. That's a unique moment of leverage for a lender. We can approach a sponsor and say, we will extend this loan, so that you can continue to own the equity of it, but we think that the rate should step up 200 basis points. We think you should pay blank in fees, 100 basis points, 200 basis points of fees. That's been a very common theme for a long time. I think one of the newer themes that we're investing in right now is just new issuance. If you think about all of the loans and bonds that exist in the market, huge percentage of them were originated in 2021. Well, if you borrowed in 2021, you might have assumed that zero interest rate policy was going to be maintained forever. It hasn't been. And so, in new issuance, we see capital structures that are purpose-built for a high-rate environment. And so you're getting, sponsors are putting in more equity, they're borrowing less, companies have more financial flexibility to deal with further rate hikes, problems that emerge in their business, whatever it might be. Some of those older credits have less financial flexibility because of the amount of leverage they took on.
Yeah, okay. So where can I access the fund?
The fund is available on just about all major platforms.
Given this, then, is there one final thing you maybe want to leave investors with as they consider this investment opportunity?
I think really long-term performance, consistent portfolio management team, success across a huge range of environments gives us incredible confidence that whatever the market throws at us in the next year, the next 3 years, the next 5 years, we'll be able to manage it and deliver for people that entrust us with their money.
A few things to leave the investors with. Jeremiah Lane of KKR, thanks for joining us.
Thanks.
And if you enjoyed the chat, please make sure you subscribe to the Livewire Market Index websites and our YouTube channel. Thanks for watching.